Hello, welcome to the Tricio investment seminar. We're going to talk about three investment themes today. I'm going to begin by talking about the investing for the post-Brexit UK recovery, post-COVID. I'll also talk about China and the risks and opportunities there. And then James will talk about how to break the curse of low yields. Here's a slide just showing the star missing from the European flag with the UK leaving, and the vaccines that we're all waiting for. Hope that they will solve the problems. But first I want to put it in a broader perspective and look at the US economic cycle, because although China has come up and is very important these days, the US business cycle is still really the key to the world economy. And this slide shows GDP back to 1960, that's the blue line, rising and then falling during the recession period, the red blocks. And you can see that over the last 60 years, we've had 5 long cycles. It was really only the 1970s that was different, when there was a series of recessions linked to the oil crises and monetary policy. But normally, the US upswing lasts 7 to 10 years. So we've just had the COVID recession coming out of it now in the US. And that means we should be good for 7 to 10 years of upswing from here. And that's very positive for profits and should be good for stock markets in that environment. So what should we expect at this stage of the business cycle? I divide the cycle into 5 stages, and I think we're still in the recovery stage, maybe in the US beginning to move into the early upswing stage. So in the recovery stage, the main thing is that there's uncertainty whether the upswing is for real or not. You have weak business and consumer confidence. Inventories are playing a key role in growth. Inflation tends to be falling at this time with high unemployment. You do tend to get more fiscal and monetary stimulus, as indeed we're seeing. You get low interest rates and low yields on bonds, and you normally get a strong stock market as investors are anticipating the recovery. As you move into the early upswing stage, there's more confidence. Pent-up demand tends to be key. Usually the stimulus stops. The key difference is that yields start to rise. And that's why I say we may be moving into this as we've seen the rise in yields in the US over the last few weeks. Let me turn to the COVID situation, where the picture generally is good. We're seeing declines in cases in most countries, or stable in a few. Obviously coming down in the UK, down in the US, also down in South Africa where they've got the variant. Also, interestingly, down in India, despite the fact they don't have many restrictions. Case numbers have come down substantially, at least until very recently. And that seems to be due to immunity developing within the population because it's been so widespread. But you can see a couple of countries there, Brazil and France, where it's flatter. And there's a couple of countries in Eastern Europe where it's been rising recently. But in general, the picture is not too bad in terms of controlling it with the help of restrictions. But obviously, the vaccines are the key here. The aim is to roll them out to vulnerable people. I don't think the number of vaccine doses is going to be the problem. We have up to 7 billion doses due from Western companies this year. That'll cover 4 billion people. The Johnson & Johnson one is a single dose, so you can get up to 4 billion people vaccinated from that. And there's another 4 billion more doses from China, Russia, and India, another 2 billion people potentially. The world population is 7.7 billion, so you can certainly do all the adults. And if you just look at over 55s, that's 1.5 billion around the world. So obviously those doses are not all available right now, and there are shortages. But as we move through, particularly into the second half, there's going to be a lot of vaccines available. So it's really a matter of time, I think. The vaccines should reduce hospitalizations. We're already seeing that in the Israeli data and beginning to see it in the UK data. Should also reduce transmissions. And the news has been very good there in recent weeks, suggesting that it does indeed reduce transmissions. 2 problems though. First, if countries relax once they've got most older people vaccinated, then you could see a surge in transmissions. And that could lead to new pressure on health services just because of the sheer numbers. And also because some people obviously will not get immunity and some people may not get vaccinated. Second issue is that mutations could proliferate and they might be immune to the vaccine. We've already seen a couple of mutations. So far, I think the scientists are not too worried. but obviously there could be a race between the mutations and the vaccines. So looking forward, I can see three outcomes for COVID later this year or into next year. One is that it's completely tamed, so particularly vaccines, but also perhaps with the help of treatments, herd immunity and burnout in some countries. So essentially it becomes not really a problem at all. We might still be wearing masks in trains, in planes. We might need an annual vaccine, but we can pretty much get back to normal, including big events, football matches, concerts, etc. Second possibility is that it's only partially tamed. Social distancing still needed, travel still restricted, maybe some lockdowns occasionally, hopefully local, but still a problem as it was perhaps last summer. The third possibility is really, we hope won't happen, is the horrific revival. Think Glenn Close in Fatal Attraction, rising up out of the bath with the knife. So this would happen if there's a really bad mutation. I'm not sure what we would do at that point. We could go back into lockdowns, try to control it that way, or perhaps we go the eradication route like China and New Zealand and Australia. But that's really only possible if you close the borders. So very difficult. So what would these three mean for the stock markets? Well, I think if it's completely tamed, then we'll see a surge in some of the discounted stocks, the hospitality, airlines, maybe some of the real estate stocks. They've obviously been coming up in recent weeks, but still mostly well below where they were a year ago. If it's only partially tamed, though, those same stocks could be in trouble. They've been staggering on with the help of government support, extra loans, extra equity, but we'd probably see bankruptcies or more bankruptcies in that area if they have to keep on going forever. And the third possibility, horrific revival. Well, I think stocks generally would be down. Maybe the tech stocks would do relatively better, but I think stocks generally would be in difficulties. Let me turn to Brexit. We're seeing some disruption and some costs to goods businesses. It's particularly the export paperwork and the rules of origin, which affect supply chains. This is affecting various businesses. We're also seeing disruption and costs to service businesses, and I think in many ways that's more difficult. In some areas, these are still under negotiation with the EU. Financial services, for example, there's a negotiation over equivalence, to what extent that will apply. Business services, media, fashion, these are all in difficulties. Nevertheless, there is a macroeconomic impact, and this slide's trying to put some numbers on that. There's obviously been a lot of numbers floating around. We've settled on 3 to 5% as the long-term hit. So from 2016 to 2030, the effect of Brexit is to lower UK GDP by somewhere in the region of 3 to 5%. That's really coming from reduced investment in the UK by foreign companies, but also all the uncertainty in the UK, the fact that it's not such a good place to invest for European business. So overall reduced investment, but also very importantly, coming out of the single market means less competition. And generally it's competition that drives productivity. However, 3 to 5%, but quite a lot of that was already taken. I mean, if you just look at where we were at the end of last year, GDP was almost certainly 2 to 3% below where it otherwise would have been. We can't know for sure, but we can compare with other countries which did very well in 2017 to 2019. And the UK really didn't do very well. Didn't have a recession, but it didn't do very well. So we've probably lost about half that already. In the end, though, I think the outcome will depend on policy. Ideally, we'd see an open economy. We'd see new trade deals. We'd see low tax rates. We'd see low regulations. I'm not overly optimistic that we're going to go a long way in this direction. I hope we don't go in the wrong direction. Certainly, we've heard about higher taxes coming. We'll see about whether the regulations get taken down. Ideally, they would, but I think we haven't seen very much from this government yet as to what their plans are. So turning to the GDP outlook, this slide shows GDP for US, UK, and Eurozone starting from the fourth quarter of 2019, so before COVID hit. So we start that at 100. You see the big dip in the second quarter, big recovery in the third quarter. Fourth quarter, the US continued on up with the help of stimulus and also less restrictions. and I think will continue to rise with the help of the new stimulus and coming out of lockdowns in various places, and then continue to rise. I'm very optimistic about the US, and indeed, if you look at where it gets to at the end of 2022, that would be 8% higher than 3 years ago. That's basically the same place where they would have been without COVID. And obviously, that's partly all the stimulus, but I see no real reason why this particular downturn, which is sort of a natural disaster, different to a financial crisis, I see no real reason why the US shouldn't get back on track. If you look at the Eurozone, it was down in the fourth quarter a little bit, down again this quarter, we expect, and then recovering pretty well, getting up to above 2019 levels by the end of this year. UK numbers need a bit more explanation. These are the official numbers. They exaggerate the decline because of the way the UK does its statistics differently to the other countries. So there's a big decline in public sector output there because of the fact that teachers weren't teaching and there were fewer hospital operations. What that means, I think, is that after the first quarter of this year, when we will be seeing a decline, I think the UK should pick up very rapidly, get the kids back into school, get the NHS doing something other than COVID again, and I'm expecting the UK also to rise very rapidly and move above EU next year. Let me turn to valuations. How are we doing for time? Okay. So this is the cyclically adjusted price earnings valuation ratio made famous by Robert Shiller. Takes the last 10 years of earnings and compares with the current price. Notice first on the right how the UK is the lowest and is actually lower than it was at the end of 2019. I think that reflects partly the makeup of the UK market, perhaps also Brexit, but it does seem pretty inexpensive at that level. If you look at the US at the other extreme, you can see we're up significantly on valuations. In fact, it's more than 35 times now. And that's obviously raised fears that of overvaluation, potentially a bubble. We've certainly seen lots of bubbly behavior in markets over the last few months, which is a concern. But I want to dissect the US numbers a bit more because I think we need to understand, whether the US is in a major bubble or not. Here's the US CAPE ratio going back to the 80s. You can see the bubble in the late 90s, up to over 45 times earnings, then down again and up again gradually. And then since the bottom of the last March, we're up significantly, over 35 times now. So on this straightforward measure, the US clearly looks expensive. Not as expensive as the year 2000, but expensive compared to most of the past. However, as we all know, interest rates are very low, and particularly real interest rates, which is what matters here, because you have to assume that company earnings will rise with inflation. So you need to compare the price earnings ratio, or the cyclically adjusted price earnings ratio, with the level of real yield. And as you can see, we're down about negative 0.8% at the moment on the 10-year TIPS yield. Whereas before the crisis, it was running in the 0 to 1% range. And go back to the early 2000s, it was running around the 2% level. This makes a big difference when you're discounting future earnings, and particularly for the tech sector, which obviously has rapid growth, or hopefully rapid growth in earnings. And so future earnings, when you have a low discount rate, they're worth more. So what Robert Shiller has now done, and I find this quite useful, is to compare the CAPE P ratio with the real interest rate. And you do that by taking the inverse of the price earnings ratio, which gives you the yield. So at the moment, the price earnings ratio is about 37 times. So that makes it about 2.6% yield, something like that. And then you subtract the real yield, which is about 0.8%. And so you come up to a excess CAPE yield of about 3.7%. People will be familiar with this if you're familiar with the analysis of equity risk premium in general. If you do this analysis, then it turns out the US is not expensive, not super cheap the way it was after the financial crisis, but not expensive. And I think we have to bear this in mind. So although I'm concerned about what clearly looks like very bubbly behavior in some markets, I think when you compare it with interest rates, especially real interest rates, it doesn't look too bad. And I should add, by the way, that the real interest rate is not rising very much. The rise in the US 10-year and 30-year we've seen is mostly inflation expectations, not the real yield. So in terms of this first item then, investing for recovery, my conclusion, the growth outlook is good. We should be set for another 7 to 10-year upswing. That makes cyclical stocks attractive. We are seeing this bubbly behavior, but I don't see valuations in the US being in a bubble as such. I think Brexit will be okay over the medium term. And where we come out then in our asset allocations is we overweight UK large and small cap, and also the US small cap, which has been doing well recently, well, the last few weeks, but we think has further to go. Come on to China now, and I won't spend as much time here, but China's become more and more important for us, so we do have to consider that. It's also a very interesting investment opportunity, potentially, and it has a big impact on other emerging markets, so very important. So this chart shows the growth in GDP per capita for Japan, Korea, and China over the long run. And excuse me, you can see the fast growth that Japan had back in the 60s, Korea had in the 70s and 80s, and China had in the early 2000s. With the other countries, of course, that tails off at some point. Once you get to a certain level of income, growth slows down. And China has been slowing now really for the last 10 years. Quite significantly. Why is China's growth slowing? Well, partly it's because the easy industrialization is over. It's relatively easy. I mean, not all countries manage this, but a lot of Asian countries have managed it. You get people off the farms into factories, making usually simple goods, primarily for exports initially, and you can really generate rapid productivity gains, rapid GDP gains for quite some time. But that period is largely over. China now needs to upscale, it needs to improve the value added, and that's a more difficult process, tends to involve slower growth. Secondly, there's no need for as much investment as before. So investment was very strong before on factories, but now they've overinvested in heavy industry. Also very strong on infrastructure, and frankly, they've gone ahead of what they really need. So they just don't need to invest as much. And when we measure growth, often we're just measuring the spending on investment, so they don't need as much going forward. Third problem is lack of reform. In fact, if anything, reform's going the wrong way. What's really needed is to reduce the dominance of the state sector and increase the role of the market. But if anything, it's going the wrong way at the moment. So I want to talk about two other issues, which I think also affect growth, the high government deficit and the high debts. So first of all, a lot of people suggest sometimes that China has plenty of room for fiscal stimulus. Well, it really doesn't. I mean, the budget deficit went up significantly during the 20-teens, 2014 to 2019. It's on the standard measure from close to zero up to about a 6% deficit. And if you include local authority investment vehicles, up as high as 12%. Now, these are not a problem in themselves. I'm not saying this is a crisis. What I'm saying is it's very difficult to expand these even further. So there isn't that much scope to expand the deficit further to get growth faster. And if we look at debt, this is total debt or total credit to GDP. You can see back in the early 2000s, China went through a kind of Goldilocks growth period where debt really didn't rise very much, but they had pretty strong growth. Then along came the financial crisis, and they got out of that by massive expansion of debt, stabilized it a bit, but then for most of the 20-teens, the debt was rising again. Stabilized a bit in recent years, but the COVID crisis has led to a new rise. These are pretty high levels for an emerging country, up near 300% of GDP. And if we look at the breakdown of that by sector, again, you can see how government debt has risen from 52% to about 86%. Again, pretty high levels. Not too much scope to expand that massively further. Non-financial corporate debt was already high in 2014. People were already saying that's the limit. Well, it's gone up a bit more, but that has been better controlled. Look at household debt. That's also gone up, and that's been one of the factors behind the housing boom over the last few years. Quite a lot of Chinese growth comes from housing, both directly, the construction, but also the materials going into it. And household debt now has reached levels where really there isn't a lot of scope to take that much higher. So the conclusion then for China, well, the economy is strong right now. Obviously, they've done a very good job of controlling COVID. We're also seeing a world manufacturing boom at the moment, and China, of course, is participating in that and benefiting from that. But we think growth will fade for the reasons that I've suggested. When we look at the market also, we have some concerns over governance in general. I won't go into that, but I expect you're familiar with these issues. It's a problem in many emerging markets, but I think perhaps particularly in China. The market, of course, is up. It's up about 50% from 2019 levels. We don't see it as cheap at these levels. There's also concerns over US-China relations, still some uncertainty as to where that will go with the new US administration. But I think there's room for difficulties there. So overall, we prefer to underweight China stocks, and we prefer other Asian countries, particularly Japan, Taiwan, and Korea. Okay, I'm going to stop there and hand over to James. I'll continue to move the slides forward just to save time. But over to you, James.
Thank you, John. I know some of you have some difficulty of getting in, and I apologize for the technical glitch here and there. So just recap, I think what John said about the first thing about the post-Brexit and post-COVID investment is firstly that we expect very good, relatively good growth and recovery going forward. Secondly is that actually the cyclical stocks look very attractive. We are worried about some bubbles in some markets like crypto and tech. And one of you asked a question about crypto. We'll probably talk about that briefly towards the end. We think UK will be okay to in navigating through the post-Brexit world. So we think in terms of stocks, UK large and small caps will be attractive, and US small caps. And we also obviously just heard John talk about China. We're worried about the growth now, but we think that it's going to be fading and market is expensive. And I think temporarily we may want to look at some other markets in Asia, which is in the supply chain as well, like Japan, Taiwan, Korea. Although bear in mind that we still think that in the longer run, as the economy adjusts, China will probably represent some interesting opportunities again. So I'm now going to talk the third topic. Since 2007, we have a crisis after crisis. We've seen firstly a global financial crisis, then we got Eurozone, and then you got COVID-19. We are seeing low rates. Central bank has kept rates really low around the world and a long period of time. Some economists call this era of financial repression because the cost of producing income has increased. Now, this is a slide that we did some calculations a while ago. What we actually did here is look at what's the size of a balanced portfolio that a UK income-seeking investor needs to maintain to get £1,000 per annum income. As you can see on the slide, at the end of 2005, you could park away £24,000 roughly to get that purely from the yield of the dividend, the yield from the gilts, and the cash. This is a balanced portfolio. We have roughly 65% of UK equities, 35% of gilts, and the rest is cash. It's now double. You need to put away nearly £52,000 to get £1,000 per annum. This cost of capital, that cost to investor to put away in terms of capital to generate this investment income has grown a lot over the years. And we can move to the next slide, please, John. And partly it's because of what happened to the yield. Now, if you think about it, if you look for income, if I can get the right level of income using the lowest risk instrument, you should just go for it. Especially many income investors are retired people. They don't want excessive risk. But at the moment, low rates have been there around for a long time. And people typically, the first option to choose is to basically park up their money longer using government bonds. So you got long dated like 5 year, 10 years, or even longer government bonds. Hopefully you get a yield. You get compensated because of locking up your money further for longer period. But as you see on the chart on the left, it's the UK and US 10-year government bond yield. You can see it's on a downward trend over the last probably more than 15 years or so, and especially after the financial crisis. Now, that's partly because of the economic situation, partly because of central bank policy, but one of the key reasons, which I'll come back to again, is buying from banks and insurers. They need to buy these government bonds so that they could keep and maintain their regulatory capital. So that's partly a reason that you can't get yield now with longer term government bonds. So what can investor do? Well, let's switch to something different. Let's go for not government, but corporate. So one way to do it is to look at investment grade. The middle chart shows that that's a AA rated commercial paper, typically short dated paper. Now, as you can see, this chart is over the last 12 months. It was roughly about 1.5%, about 12, 15 months ago, spike up during the beginning of the pandemic because people feared that corporates are going to go into default because of the economic slowdown and the shutdown, etc. But then it drops quickly. It dropped to close to zero. Two reasons, obviously, central bank cutting interest rate around the world, ECB, BOE, the Fed, some even have negative interest rate. But also, there's also buying from the central banks on these papers. That actually means that even when you go down to lower rate corporate bonds, investment grade, but it's not as good as government, you don't get a yield. So what do we do? Wow, let's go even worse. Let's basically go to non-investment grade, high yield bond, and longer investment horizon. That's the right chart. I frequently show this chart because it's actually quite scary from my perspective. This is basically US high yield bond. That's the yield from there calculated by Bank of America and ICE on an index there. You can see on the red circle there, there's a spike. This spike was around, again, 12 months ago when the pandemic first hit. But then, again, as I said, the Fed steps in, for example, buying ETFs on corporate bonds, buying corporate bonds, and ECB doing similar things. And people start to think, actually, government is actually doing some backstop there. And because of that, and the need for income, people keep piling into these high yield bonds. As prices go up, the yield goes down. You look at the yield now, it's quite low. In fact, if you base on the yield to look at the implied probability of default, if you think that actually the default is quite low, it's even probably around the same as economic boom time, which doesn't make sense because many economies around the world are still in lockdown. So this may change. And so we actually think that there's something interesting here about the yield. So next slide, please, John. So this is typically what we do when we taught in when we do our study for finance or do our professional qualification. They tell you yield are driven by macroeconomic fundamentals, interest rate, and also inflation outlook. Driven by credit spread, who is the issuer? What's the maturity of the bond? But there are two other factors that actually I mentioned already in the previous slide, and I think we will just summarize it here again. Market structure, this one set of factors. Central banks have been buying corporate bonds, and basically they can allow banks to use some of these corporate bonds as collateral to get short-term cash. Banks don't mind underwriting that bonds because if there's a worst case, I could pledge it with the central bank and get good funding. And because of that, the issuer also think, why don't I have to borrow directly from the bank? Let's issue as bonds. And because they know income investor want bonds. So market structure have changed. Because of that, it's driving yield. The central bank buying and accepting these corporate bonds as collateral have been keeping yield low. There's also investor behavior. Need for income by investors, the demand for banks and insurers on government bonds, I mentioned about that. And there's also a false sense of safety. oh, government is providing a backdrop. Government don't want defaults of companies. Look at the yield, etc., etc. Is implying that they is relatively safe. Now, these two factors distort yield, and you basically say that actually it is probably going to cause issues in future. So just next slide, please. So just to recap, basically what has been happening is that the cost of income is very high because low yield environment. Some of the yield of fixed income instruments look mispriced. And if the situation driven by the market structure due to central bank buying and behavioral issues like buying by banks, buying by income investors, all these change, the yield can go up. And these mispriced securities mean there's a risk there. So if you're an investor, you pick your instruments at the moment, you probably try to pick some you very hard to find. You actually start to increase risk. Some of the instruments may look safe, but they're riskier. You actually start to bring in more potential credit risk in your portfolio. So in this world, we have to actually change the way to construct income portfolios. So to recognize that some of the fixed income instruments out there, they yield a mispriced for the risk. We also need to embrace using alternative investment, which I briefly mentioned later, and also try to create a new way to construct portfolio. And this is what I'm going to discuss next. Next slide, please. We split the portfolio into three parts. Okay. Imagine that your portfolio is an income money tree. The liquidity or the liquidity pool that's saying A is actually the fruits. These are low-hanging fruits. This is actually what you need for your day-to-day living. That's the income. And usually what we do, you could park it, put it into fixed income, short-dated money market fund or cash over short term to make sure that the investor will get that income over the short term. And you pull the fruit off, you need to regrow the fruit. And you need something that actually have relatively good yield and basically try to grow the fruit again. It's like the fertilizer to grow the tree. So we're trying to produce income, which is from B, which is the yield enhancement portfolio, to replenish the liquidity pool. Now, in the past, you could use fixed income, as I mentioned, but many fixed income instruments are mispriced. With the better investments, in our opinion, that would be out there. I think there may be some real assets, like some REITs in specialized sectors may be interesting. Some decently run income funds may be interesting. And also income-based structured products. I used to do quite a lot of these with clients as well. Structured products are linked to, perhaps, for example, equity market, but have some protection built in. So because of that, you got enhanced yield, but not taking excessive equity market risk. By doing all this, you create a decent yield enhancement part of the portfolio with rightly priced income instruments. So you got the fruit, you got the fertilizer to keep the fruit growing, but you also need a decent tree. The tree need to be strong. And that is where the capital growth element in. We actually need the portfolio to grow such that it will protect the pool, the whole portfolio, against inflation. If the inflation goes up, it will erode the purchasing power of the portfolio. We need some growth there. We also need to put in some elements of growth there because of the current environment, because of the yield. Sometimes you do need to crystallize some of the growth to help to sustain the liquidity requirement. So this is the controversial bit. Usually income investors don't like that because it increases the risk because you will put into equities. I mentioned equity funds there. Maybe sometimes individual equities, especially if they look cheap with good dividend yield. And what I would also mention, alternative again, real asset type, or also structured products linked to with a growth payout, such that again you got enhanced growth if the market goes up, but also protect against the downside. These type of instruments change the risk profile, and investors and advisors need to embrace these things such that you develop a more robust solution for your clients. So I just will conclude with the last slide from my bit. John, please. Next slide. It's not moving. Probably. There you go. Thank you. So I just want to conclude 4 points. Beware of fixed income securities with price yield. Some appear safe but are actually riskier than what their yields imply. Some appear risky based on the yield but are actually decently priced in terms of risk. I mentioned some REITs. I mentioned some asset-backed securities. I mentioned structured products. S&P recently put out a report and actually thinks that trade finance credit is an interesting asset class. It's because of the market structure have changed and the yield looks attractive. That actually is the first type of product. The yield looks risky, but actually is decently priced. And advisors need to control risk better. We propose this goal-based asset allocation framework. Split the portfolio in different parts using different investments to support the whole investment objective for the client. I think I'll end here. So I think, John, you move on the next slide. You got some information from us. I went through some stuff about the example of the asset allocation. If you want to hear more on the details, feel free to contact us. We're happy to have a conversation with you. And then if you got any questions, you could actually type it in the chat box now.